Hello to all traders out there. This video is about one particular aspect of your trading activity which could cause you to lose a lot of money and you might not even notice it. It's the spread. So the spread is the actual difference between the bid and the ask price of a certain instrument. So I have here the gold instrument and I'm using the TradingView charting platform, and this price comes from Wanda, and the difference between the sell price and the buy price is currently around 27 pips, right? And this can actually be very different because of the market conditions or because of the broker of the trading conditions that your current broker is offering to you. As you can see now, it's been 30, okay? And if I'm moving to another charting platform, let's say an MT4 with a retail trading account, gold is trading at around 46 pips, as you can see here, okay? And if I'm moving to an MT5 platform, gold is trading at 24 pips. Now this is in ticks, that's why it's in hundreds, so it's 2400s, right? 240, sorry. So this the spread can differ, and the best thing for you is to choose a broker which can offer you the best trading conditions, and one of them is narrow spreads. So regardless of this, the spreads can vary throughout the time of the day and period, the economic context which we're in, and the volatility went crazy basically in the past few days, starting from currencies and ending with the stocks, indices, commodities, everything. So in this kind of market conditions, the spreads would basically widen, right? So if this is like normal trading conditions with 20 pips, 25 pips on gold, then in volatility conditions that could rise even to be double or triple, and the spreads could be so much different in a short period of time, in minutes or even seconds. And if you're trading manually, you cannot control this. I mean, I said in this video that you could lose a lot of money from the spread, and let me just show you how. So this can basically apply to particularly those of you who are trading using market orders. So you could trade in a venue which is exchange based, where you can trade against other people or companies, okay? And or you could trade against your broker or an liquidity provider of your broker on the so-called OTC instruments. So regardless of the type of trading, if you're using market orders, then you would basically have an instant loss in your account, potential loss in your account when you're trading market orders, because let me just pull up Blackboard. So let's say that you're trading gold, right? And gold prices would be usually trading at about 25 pips of spread. So usual gold is trading at about 25-30 spread, which is this, right? Okay, so if you're trading market order, then that means that you would buy here, and if you'd like to sell and the prices would not change, so if you'd like to sell right after you bought, then you would sell here, and basically this difference, it would be your loss. Okay, now this wouldn't be so bad if the spreads would be narrow. However, if the markets are in a volatile period like we saw in the past few days, that would mean that the spreads could be very, very different throughout the day. For instance, like this, and in short periods of time. Okay, so basically what happens is that if you would buy here, you would have a potential loss of 25 pips, which would be acceptable, let's say. But if you bought here, then it would be like, probably it would be like 60 pips, right? Or whatever. Here it would be like 50 pips. Now, this is important because this difference basically between 25 pips and 60 pips would be taken out of your account, and you accepted it because you're trading using the market orders. Now, if you're trading manually, you would have no control over this situation because you would not know. So try to imagine that you would see spreads like here you'd see normal spreads of 25 pips, but in the next second from here to here until you hit the buy button or sell button, the spreads would go like it would increase maybe double or triple. So in periods of high volatility, this could happen very often, and if you're trading manually, you cannot control this thing. However, if you are trading using an automated trading system, you could choose to have a parameter which basically controls this. So if all the other trading conditions are met according to your strategy, the trading system would actually also check the spread, and if it would be above a certain value that you would set, let's say for instance you know that you want to trade at the most 30 pips spread in gold, right? So you would set the 30 pips as a threshold. So if that system would met the trading conditions here, it would basically not place that trade because the spread would be too high. And almost all platforms and all brokers accept automated trading systems, and for sure MT4, MT5 and TradingView are accepting. They all have their own programming language, and they can accept automated trading systems. However, you would need to actually have in your own automated trading systems one parameter that would control the spread. And in this way you could actually avoid trades that occur when the spread is high. So you could basically save a lot of money in your account.